we'll start here. What do you know about the 2008 financial crisis?
Basically, leading up to 2008, the reason why there was a housing bubble, it wasn't as much as inflated. The fear now is inflated home prices and lack of buyer demand. In 2008, it was a result. In 2008, the crash was a result of basically shady lending practices, at least from my understanding. There were very little regulations put in place. I've spoken actually to a lot of lenders that were in the industry at the time that are still in the game that kind of walked me through how wild it was. It was like the Wild West. There would be now whenever you go through the process of buying a home, they ask for tax returns, income statements, bank statements, proof of income for the last 2 years, and they give you a roundabout number of what they'd be willing to lend you based on all these calculations. Back then, it could be as simple as asking you on the phone, yeah, so how much money do you make? Oh, I make $1 million a year. Okay, fantastic. I'm gonna draw up the pre-approval, send it over your way, not even checking for second mortgages, anything like that. It was very little verification. And it wasn't just it wasn't just that the economy, it wasn't just that the housing market crashed. The entire economy was built around, if you've seen the movie The Big Short.
Yeah. I was going to talk about that. The Big Short, yeah.
With the way that they would set up, like, the secondary market, whenever Fannie, Freddie, Ginnie Mae buy the loans throughout the entire country, they were built on a house of cards, basically, from all of these, not subprime loans, but unverified shady loans.
I think they were packaged though as safe loans. Yeah, some of the financial packaging of these loans where they would package them together and sell as a security, basically, or mortgage-backed securities, they call them, were considered like, they had like rating system where it's like AAA, AA, stuff like that, and they were considered, some of them were considered like safe. But they were composed of these mortgages with people with little to no credit and a lot of debt. And they were sold to the American public in a lot of the sense as something that was secure in a place you could park your hard-earned retirement funds. And when the bubble fell through, then a lot of people just lost that money and with no return.
Yeah. But even if you look at the charts, maybe we could put something in the video and post. If you look at the chart, the market crashed. The real estate market crashed. None of these are ever, if you look at the 80s, where there was an extended period, like I think it was close to a decade of steady decline of the overall market. The 2008 crash took a hard nosedive, and I think it actually hit like late 2008 to early 2009, and then bottomed out and steadily rose since then. The Fed stepped in, started cutting interest rates because they were going through a recession, just like they always do. And then from that point, interest rates steadily fell until they bottomed out in 2022 and then started to peak again. And now we're back at around the 6.5, upper sixes range.
Well, yeah, and if you scroll down on the note, there's only been 3 real estate market crashes in U.S. history. The Great Depression, where everything crashed, but it says that basically home prices dropped as much as 67%. Wow. Which is, imagine like your house going down 67%. That would actually ruin people. The second was the 80s to 90s, the savings and loan crisis, which it seems like it was a mini version of the 2008, or a more drawn out, prolonged version of 2008, but not as severe, whereas 2008 was like a sharp, very severe crash. Of course, that's probably was one of the best times to actually buy real estate, when the market itself crashed.
Well, that's always what it is.
Yeah. Well, going into that then, do you think there is a potential, it seems like that there is a crash every about 30 to 40 years in the real estate market if you keep with the current crashes that have happened. So the last one was 2008, and so we're in 2025. Do you foresee that there could ever be a future market crash in real estate, and what would that even look like?
I mean, I'm no economist, but if you're just going on basic supply and demand economics, then I don't think that we're going to see a housing market crash. You may see it in the broader economy, but that has nothing to do with the housing market. The housing market's a tiny subsection of the overall financial market, the money circulating. Yes, most people have their whole life savings tied up in their house, but I don't know the exact statistics behind it, but the wealth it's the simple 80-20 rule. The wealth is concentrated in the upper 20%, probably mostly in the top 10 to 5%.
Top 1%.
Yeah, really.
Yeah.
You could look at the top 10 companies on the S&P. That's the majority of the entire market.
Really, the real money is in the top 0.01%.
Yeah, exactly. Well, if you're talking about overall numbers, the individuals who actually hold it, yes. But that being said, if there's a crash in the market, I don't think it is anything real estate related. People would make the case that the 2008 financial crisis was a direct result of the housing market going down. I don't think that we're going to see anything like that. Housing may take a dip because of, if we're going by simple supply and demand economics, there is still a shortage of housing. But if buyer demand falls off enough to where there's just no spending, then you might see housing prices start to fall. And so it would be, if the housing market took a dive, it would be a result of the overall economy, not a result of internal struggle within the housing market itself.
Yeah. What about the contractors in terms of building new houses? Yeah. In terms of building new houses, what about the contractors who the materials to build houses have been sky high? And do you know if they've actually come down since
their peaks? Yeah, but they're still high.
Still high.
It's a result of overall inflation. I don't know how exactly that will work, as the United States puts tariffs on other nations for steel, lumber. A lot of that stuff is outsourced. A lot of it also is internal. It's stemmed up from the country itself. I really don't know how that will affect. I would assume it would have some effect. Yeah, you might see some, costs of development going up because of that.
Yeah, I think it's safe to say that there will be some effect, obviously, but I actually don't think anybody knows the extent of what the actual effect of that will be until it happens.
Yes.
No one, everyone's guesstimating on what's going to happen. Some people say it's going to basically tank us to the bottom. Some people think over the long enough term, it's actually going to bring us more riches, because in the 1800s, that's primarily how the U.S. acquired money. Besides paying property tax, there was no income tax. And so we had a lot of tariffs. A lot of other countries paid us for the goods that we exported. And so, we haven't done this in 100 years. And I don't think anyone actually knows the extent of what's going to even happen.
Well, I think the long-term effects, I mean, again, this is purely speculative.
Yeah.
We're not financial advisors, we're realtors, but obviously we study the market closely because everything's interconnected. But over the long term, I think it will be positive. I mean, in the past couple months, there's been over $1 trillion, I think $1.5 trillion pledged from foreign companies to invest. Apple dedicated $500 billion to build a gigantic, a mega plant in Missouri or something like that. There was a chip company from Taiwan that pledged another $100 billion. It is incentivizing foreign companies to build their product in America. And so long term, I think that it would be a positive thing. But in the short term, somebody said this, and I thought this was really insightful. When you look at China famously had a 100-year plan. where, they're not in any way a shining star to be embodied, because it is a communist country, that the people on the lowest peg of the totem pole probably are suffering or have suffered as a result of their overall economic plan, but they think in terms of decades and the future prosperity of the country. In America, we think in terms of quarters. Like this, yeah, it would be a good thing for 4 years down the road if we made all these changes and the economy followed suit. But what am I going to tell my shareholders at the quarterly board meeting when I have to show them the stock price has fallen 20% or whatever it is? And so who knows if these policies will be followed through, because I think that there will start to be more and more pressure from some of these, 0.1 percenters who have a lot of shares tied up in all these various companies, and especially as midterms approach.
Yeah. I think as midterms approach, we just started.
Those are the things they're thinking about, though.
Yeah.
The vision has to be accomplished by the midterms.
What about like those ghost real estate cities in China where they've built like these huge structures and no one's living in them, and it's like a ghost city?
I don't really know a lot about it. I know that there's a few places in the Midwest like that. I don't know if you've ever seen that social media page. It's like Abandoned Midwest or something like that, where it's these giant mega complexes, whole communities developed, and it's just completely abandoned with nothing.
Yeah.
Now, though, the problem is not an overabundance of places like that. It's a shortage.
Yeah.
New builds need to go back up. I remember when the market first started to take a dive in 2022, I was working with a couple of investors and trying to secure their business. And one after one, they all fell off and be like, yeah, we had 60 plots of land that we were going to be developing on and locking in rates, construction loans and stuff like that. We're selling all of them right now, except for maybe one or two.
Yeah.
And I think that developers are still crawling out of that hole for spec homes.
Yeah, because developers' construction loans are high risk to a developer with higher rates.
Much higher rates, yeah.
And
typically a lot larger down payment as well, minimum 20%.
Usually they have to put up like a bond too to cover
That's true.
the money themselves, basically, if they don't complete.
Or else the consumer has to take the risk.
Yeah.
That's in a not a spec home. There's a difference between a spec home and, Uncle Joe hiring a builder to build their home. A spec home, a builder builds speculatively, customizes it as they see fit, and then puts the finished product or the developing project on the market to then be sold.
Yeah,
Whereas some of these developers, the business model is they're trying to get to the client before anything's drawn up. They're doing the renderings, they're drawing up the blueprints, and then they're starting being funded by the buyer. So the buyer is the one who's actually securing that loan, in which case the builder would then need to secure a bond in order to make payments.
Yeah.
One thing I could say, though, about the market going down and what it holds, in our area where we conduct a lot of business in and around New Orleans, we are starting to see some home prices fall, especially at the luxury end of things. Plus $2 million homes, stuff like that, in some of these more affluent areas. But we've seen rapid growth. And our growth to the North Shore, where we do a lot of our business, was stimulated from people leaving the city and wanting to get more value, basically, for their property. But in markets where you've seen huge influx of prices, like Florida and Austin, Texas, and I think Atlanta too, there's several markets across the country that, since they peaked in 2022, year over year, have already been experiencing prices continuously falling. That it's not sustained at what it is. We're still at the top of our market, so maybe we might start seeing prices falling a little bit. But until the supply goes back up in our area specifically, there is still a demand for, let's say, the mint product, the thing that everybody wants. But you can talk about how you saw some of those crazy markets for the place you wanted to buy in Florida.
Yeah, there was a place that I wanted to buy in 2020, August of 2020, of a 1-bed, 1-bath with like kind of a stacked children's bunk in the hall when you walk in, so you can have like the mom and dad in the bed and then some children.
It was a condo near Rosemary Beach in Florida,
near
right?
Rosemary Beach, 30A, and it was going for $400,000. And it was around the time when I was unsure. I'd never purchased a home myself, and I could have bought it, but I kind of hesitated because I was like, maybe I'm getting myself into something that I don't really know about. Well, it sold later that month for $400,000, and then relisted again in November for $780,000 and sold again.
The same year.
Same year.
So within, what would that be? August, September, October, November.
3 months.
3 months. It nearly doubled in value.
Yeah, nearly doubled in value. And and I was like, whoo, that's one of the biggest mistakes that I've made of not purchasing that. Mm-hmm. And right in December, Florida, there was a thing where you could claim a beach condo as a second home, and you could get a 30-year loan with favorable rates. Mm-hmm. And they got rid of that in December, where now you could only do a 15-year as a second home.
There would be a way to do that, though. A way that you could still secure a 30-year loan would be if you are in a position to where you could get a second mortgage in order to buy a second property, like a beach condo, what you could theoretically do would be refinance your own home on a 30-year fixed period, and then take that cash and invest it and pay for the condo in cash. So there are ways to get around it, but I don't think a lot of people who would be looking at that may not be as up to date on some of the more creative ways to make that happen.
Yeah, and it definitely makes it more difficult.
Yes. Another thing is a place like Florida with all of, when the condo complex collapsed, and I think it was Miami or Fort Lauderdale, one of those, this big high-rise condo building collapsed and killed a bunch of people. They're cracking down on the insurance companies, or rather maybe the insurance companies are cracking down on those individual establishments to really make sure that the structural elements of the building are where they need to be. And the people who are paying for that are the homeowners. And so I would say that the Florida market is probably at peak or is dropping from peak right now, but that would be one that I would say, those prices will probably continuously drop. As opposed to a place like where we do a lot of business and around New Orleans, I don't think that that's the same case. Mm-hmm. Yeah. I think that prices are going to remain where they are or grow a little bit, 2 to 3%.
Mm-hmm. To say candidly, talking about real estate, there's only so many things you can actually talk about real estate without like re-upping the same points and going in circles.
Yeah.
Like, there's only so many times you can say, interest rates and,
Well, yeah, I mean, the whole thing is there's, like, if you look at a channel like CNBC, which is dedicated exclusively to giving you hour by hour news on movements in the entire economy, like, most of the time there's nothing to report.
Yeah.
It's more entertainment than it is informative.
Yeah.
It's their business model is, it's not even about being right. It's they're literally reporting the news on the economy every day. And so if you look at the headlines, it's like, the S&P dropped by 200 points, stimulating fears and uncertainty for the future of the economy. And then the next day it'll go back up. S&P rebounds 400 points on positive news from X, Y, and Z.
Yeah.
Policy put in place. It's like, if you're worried about that day to day, you can get lost in the sauce.
Yeah.
You need to zoom out, and like you did, like look at the trends from history if you want to understand the present. Mm-hmm.